So guys, it's 8 o'clock, so I'd like to go ahead and begin our class this morning. So I appreciate you all being here, and we got a few others that need to join us still, of course. We're going to go ahead and move directly into the concept development presentations. And you'll remember today that, excuse me, I'm looking for something on my screen. You'll remember today that we're going to start with angel investing, and that's going to be Reed, and then we'll move into venture capital with Ashlyn, and then we'll move into private equity with Hayden. And that Alex is the discussant for the angel investor discussion. Skylar is the discussant for venture capital, and then Fred is the discussant for private equity. And remember that following each of these, I may go ahead and assign somebody to do the quiz questions for the day. So with that, Reed, I believe that we're set up so that you can share the screen, and feel free to go ahead and do that and tell us about angel investings and seed funding.
All right, sounds good. Can you guys see my screen okay?
Yes.
Is my PowerPoint up right now? Can everyone see that? All right. Hello, everyone. My name is Reed Arnay. For those who weren't here on Monday's class, I'm from Southern Oregon. I'll be a senior this fall, and I'm studying finance and philosophy. So today I'll be discussing a little bit about angel investing and seed funding. And if any of you guys have questions or comments, please feel free to jump in. I'd like to keep this an open dialogue. So let's get started. I think I can speculate that most of us have been recipients of angel or seed funding in its simplest form, whether it was getting the necessary funds to open up a lemonade stand or borrowing money to buy glow sticks, buy in bulk and then sell those at school. We're familiar with the idea of obtaining capital to create business or launch a product, and then in exchange for a portion of our proceeds. So in many cases, whatever endeavor we embarked on, we first confided in someone that we trusted and help us make our money making dreams come true. And fortunately for business women and men, relationships like this continue to exist in professional spheres. So let's look at WhatsApp, for example. Brian Acton and Jan Koum, they both left Yahoo in September of 2007. They went and traveled the world for a little bit, and when they came back, they both applied for jobs at Facebook, but were rejected. 2 years later, Koum bought an iPhone, and he realized the potential of the app industry. And so he got together with some friends, and he actually made an app that allowed you to see statuses next to names of contacts in his phone. And then in February of 2009, he incorporated WhatsApp in the state of California. Later that year, his friend Brian, the one that he worked with at Yahoo, persuaded 5 other former Yahoo friends to invest like $250,000 in funding. And as a result, he was granted co-founder status. So in that space of 3 years, Jan and Brian saw the app transform into like a free texting service. And with the backing of Sequoia's 57 million, their monthly users went up to 400 million. And so in February of 2014, just 5 years after the app's inception, Facebook acquired WhatsApp for 19 billion, and which is probably, I think that's one of the largest acquisitions up to this date. And it's incredible to see how such successful and dramatic events rippled from that early investment of $250,000. And so financial support at an early stage can make all the difference for a small company, and that is called seed funding. And so seed funding, you can kind of think of the seed funding as part of an analogy for planting a tree. So this early financial support is ideally the seed which will allow companies to grow into large businesses. Seed funding helps a company finance its first steps, including things like market research and product development. With the right type of seed funding, a company has assistance in determining what its final product will look like, what the marketplace that they're targeting will be, and it generally will help them employ a team for them to get those things done. There are many potential investors in seed funding, which can include founders, friends, family, incubators, and early stage venture investors. But one of the most common types of investors in seed funding are called angel investors. And while family and friends can technically be considered angel investors, there are more deliberate and organized angel investors out there. And so in a more organized and technical space, what are angel investors? Essentially, they're high net worth individuals who fund startups in their early stages in exchange for convertible debt or ownership equity. And so these business ventures that angels invest in sometimes are not sufficiently developed to stand on their own or sufficiently attractive to gain venture capital funding. While startups are high risk usually, they don't represent more than 10% of an angel's portfolio. So typically in the early stages in the firm's management, the team will lack experience in growth venture. And so this is where the angel investor will step in and provide the necessary mentorship, often sharing industry or startup experience and providing access to strategic partners and networks. And so I was looking in my research and I found this interview that Stanford School of Business did, and they interviewed a man, his name was Aiden Senku, and he stated that his angel investing strategy wasn't like a hands-on approach, but he called it high value add. And so what he means by that is that he's interested in the milestones of a startup company's history. So he's interested in those significant events rather than being there every day when the founder needs him. And some milestones that he listed were, the first one was like acquiring the right initial fundraising and securing that lead that then kind of gets the right investor mix going. He also mentioned that he helps at hiring during critical time periods in his history and providing support during crucial sales decisions. And then, of course, after that, being there to make sure that the company is exposed to the right people when they're trying to become acquired. So entrepreneurs often view angel investors and their networks as like a bridge to future VC finance or acquisitions. And so choosing the right angel can be huge. And then lastly, and while this isn't a prerequisite, a lot of angel investors are normally individuals who have gained accredited investor status. And so what this means is that the SEC defines them as a person who has a net worth of 1 million or having earned 200,000 in income from the previous 2 years. So here's a visual charting the startup financing cycle with angels and seed capital occurring very early on. And I think it's important here to stress that while angel investors or angel investing can be extremely lucrative, in the end it's extremely risky. As you can see, the angel funding and seed capital occurs during the time period that's labeled the valley of death. And I think that's interesting because the American Angel campaign reported that just under 10% of their total portfolio yielded positive exits. And so even with expert networks and that additional money and seed funding, many firms may never get past the break-even stage or even make it to early on VC stages as well. I think that's important to note that not all of these ventures will be successful. This visual provides a more holistic view of the investment landscape and includes details like the company product stage, the investment that might be needed at that time, and then the corresponding company valuation. And as I previously mentioned, angels normally invest after their own funding has run out from either family members or the founders themselves. And so 65% of an angel investment will be around the range of 150 to 500,000. And that number will obviously increase when the risk is shared among other people like you see in angel groups. And so this past 10 to 15 years, there's been like an incredible rise, I guess you could say, of angel investment activity. It's really taken off. Surveys by the Center of Venture Research indicate that the total U.S. angel investment market grew from 17.6 billion in 2009 to 24.1 billion in 2014. And then on like a global stage, that number, the total angel investing market in Europe has doubled, and in Canada it has tripled. So I wanted to take a moment for a second and ask if any of you have any thoughts as to why there's been so much growth in the angel investment space, and maybe Rick and Jens, if you could weigh in too as to why you think there's been this increase in activity.
I think that the beginning because the cost has gone down, and also that there's been a lot of acquisitions going on. So, for instance, angel have sold their companies, so they have this cash to use to invest in new companies. And recently, we could see that in the last 10 years, that there's been a huge amount of cash in the market. I think, therefore, there's been also a lot more activity in the angel investing.
Yeah, I think that's a really good point, and we're seeing a lot of more activity for sure in that range. Does anyone else have any comments that they'd like to add in?
So I listen to this podcast every morning, and they were talking about the current situation in the United States, and they were mentioning how at least 50% of the economy is dependent on small businesses. Mm-hmm. So looking at all the big companies and looking at all the money they bring in and help the local economy here in the United States, but 50% of the United States is like small companies. And looking at that, I know that I feel like people who have the ability to invest become angel investors, thinking, well, we need to start putting our money where we know it's going to grow. So people are getting smart about, their businesses and having great ideas, and things like Airbnb, for example, started out kind of that way, I believe. So I think that's the reason why.
Yeah, I think that's totally true. And you mentioned a couple points that I'll make in the future. So in my research, I came up with a couple of maybe compelling possibilities as to why there's been like a huge rise and shift towards angel investing. And
Excuse me. Reed, can I also weigh in?
yeah, go for it.
So I wanted to present this argument. I believe that the average lifetime of a company on the S&P 500 50 years ago was about 50 to 60 years. Currently, it's 18 years. So on average, every company in the S&P 500 stayed in there for 18 years. And I think the underlying technology that makes that possible is the internet. So you've seen, for instance, let's take the example of AWS, Amazon Web Services. They do servers, right? So you can, instead of building a company and building out servers and all that stuff, you can subscribe to all these underlying services that make it more or less expensive to build companies, so they can scale faster. So the return for the angel investor also becomes a lot more attractive, which attracts people into that industry. Let's just
I think that's totally true. And I kind of mentioned that in my fourth point here when I say the mainstreaming of entrepreneurship. I think that also coincides with the influence of the globalization of technology and how social media and just the overall sharing of information through technology has created this culture that allows people and encourages people to kind of make that jump or make risks. And I think especially among millennials today, there seems to be like a general shift in what a career can look like. And so with the technology that you were saying and how it's cheaper to start businesses, we're seeing like a trend where people are taking that risk and they're being progressive and pursuing their passions. And so they're dreaming big. And I think that's a huge part of what you were saying. And that explains like why there's a rise in angel investing. Going to the top of my list, I have professionalization of angels. And what I mean by that is just in the last 10 years, the U.S. has seen like the formation of resources like the Angel Capital Association that helps angels become more knowledgeable and professional with forums and other training materials. And so people who are young or starting out in their angel investing careers are able to learn faster and learn better and interact with other more veteran angel investors. And then a huge part with the rise of angel investing, and it's an aspect that was in that past visual, is recently in the past 15 years, angel group formations have really risen. And there's like an estimated around 400 total groups now in the U.S. And there are a lot of advantages, I think, to approaching seed funding in a collective manner. For one, at least, group formation allows investors to divide ownership stake among several investors. So instead of swallowing like a single 600,000 K, angel investors can split that up and in like $25,000 increments. And so that allows the whole process to be more accessible, I think, to more ordinary people, I guess. And then also investors who band together can split the considerable due diligence work. And so I'll get into that a little bit later, but they're able to split up what they have to do to like vet other startups, and allowing people to do that can kind of allow them to focus on other investment projects. And so there's like an increase in time because of that. And then also when you're in these angel groups, you're constantly hearing about other deals. And so that provides like a steady flow of leads that would be hard to achieve if there was just one single angel investor working solo. And then there's been a growth in online investing syndicates or portals, which basically allows high net worth individuals to work together or even share deals. often with no annual fees or scheduled meetings, which brings more investors to the table and is at a lower cost for entrepreneurs because just in terms of time and effort. And like there's even some syndicates out there that will allow you to invest as little as $1,000 into a business venture, which again lowers the exposure to risk, making the whole angel investment endeavor a more approachable project. And then there's this new exit math. What I mean by that is that I feel like a lot of companies in my research have recognized or realized that obtaining an IPO obviously is a great thing and a great goal, but sometimes it's just not realistic or attainable. And so they're more looking for personal or investor liquidity through like acquisition by a strategic buyer. And so these acquisitions are smaller than IPOs, and they generally cost around in the neighborhood of like 20 million. And so for an entrepreneur looking for a good return, they can't raise and burn too much capital. So seed funding through angel appears to be like the most pragmatic approach to that. And then lastly, changes in the VC world. So I've all heard like in the news, like the big stories of big VC companies like the one, Sequoia, that I mentioned in the beginning of my presentation, have like large mega funds that have emerged. But oftentimes these huge funds may not be a perfect fit for a smaller but very high quality startup. And so perhaps the founder of the startup doesn't want to raise so much money in the early stages at a low valuation because they might lose voter control. And so they've decided to preserve the option of staying true to maybe their original vision and growing the company organically. And so those are a few of the reasons why I feel like there has been this rise in angel investing. And I appreciate the comments that everyone gave.
So Reed, can I add what might be one additional reason to this?
Yeah, go for it.
So if you think about it, in the same era that we've seen the decrease in the barriers of entry and this explosion of innovation, we've similarly had a change in the regulatory environment, such that it's made it much more realistic for people of regular means, perhaps. And when I say that, I've got to be a little tongue-in-cheek because I'm suggesting regular means might even include the investor that can put in $1 million. And I'm not sure how normal that is. But we've seen this change in the regulatory environment that has increased the amount of activity available from investors that otherwise would have been shut out of these markets because of regulatory constraints. So that's made a big difference here as well.
Thanks for that. I appreciate that. So now that we've kind of discussed what seed funding is, what the profile of an angel investor is as well, and then the rise of angel investing and the rise of angel groups, I wanted to kind of transition towards the startups themselves and focus on them and figure out what angel groups are generally looking for in startups and what's the evaluation and investment process like for most angels. So this chart shows which specific aspects of an early stage company are considered most by angel investors or angel groups. And so for this particular group that's based out in Pennsylvania, they place management team experience at a weighted 30%, opportunity size and maturity at 25%, product or service at 20%, technology, product uniqueness, and solution at 15%. And then interestingly, investment structures last at 10%. And what I think is really significant here is that it shows the importance and the overall value that firms put on the helm of whoever is running the startup. And so I think that's significant because they're asking questions about the people that are being involved in the deal. So is the CEO coachable? Does she possess leadership qualities or vertical experience, or is she even likable? So if an angel investor isn't able to work well with a management team or notices striking internal conflict, it's very unlikely that they'll invest. And I think this is evidence that business really is about people and their ability to connect with each other and build meaningful relationships, because that's what drives value in business. And angel investing is no exception to that. And then there's what angel investors are expecting when they invest in a startup. And so here are a couple of qualifications of an angel investor that an angel investor holds onto, and they kind of appear as follows. So they stress a potential for the company to grow and scale. And so there's an expectation that the firm will reach a $30 million minimum in revenue over the next 5 to 6 years, with an emphasis placed on high gross margin. And the next is this startup needs to have a competitive advantage of some kind. And whether that's occupying a large niche market, or is able to verticalize, like Jens was saying on Monday, into a category, that'll be attracted to angel investor groups. The third is whether management is operating based on a realistic and correct valuation. And then the fourth one that I saw in my research is that the business must be capable of providing a return to investors through an acquisition. And so there seemed to be an expectation of a 10 to 30 times return on investment, which is important because more than 50% of businesses will fail. And so angel groups are looking for those one or two investments that will make up for the remaining 6 that fall through. And so these expectations would certainly be addressed as the CEO or founder kind of presents their business or pitches their company. And I wanted to open it up and ask the class if they've had any experiences pitching to investors or have any insight into the process. I know I personally haven't, so I wanted to take time and maybe ask you all, and Jens and Rick, you can probably weigh in on this. What have you seen work and what fails in this pitching stage?
So Victor, you've had some exposure here, haven't you?
Yes, that is true. So what we found very important during when we were pitching to investors, that they wanted to always see cash flow. Well, cash flow is king. Even though in what kind of stage you are, they want to know when the product is going to be ready and when you're going to expect any cash flow. And for us, that was a difficult task because we were doing a SaaS business, so software as a service, and we were developing the product for a very long time, and we got funding for about 300,000, and eventually we did not get the product ready in time, so we got cut from the funding. However, we're still in the process that we're working with the business, even though we did not really receive enough funding to continue full time on it. But the most important thing, what we saw, is that we needed to concentrate on small things to make the service work fast and really to receive customers faster and to really have cash flow. That was the driven factor that we saw. Also, the team has a huge impact on investors, how they behave and how likely they will invest. But those are the few points that we found very important.
Yeah, I like your first point. The research that I found in the do's and don'ts of pitching to angel investors, I think every single one of them focused on kind of moving away from just pitching your idea and really talking about like what's on the cash flow statement, what's going on in the business aspect of it. Because I feel like a lot of people who, who start up a company are really excited about this thing that they've created, and they love to talk about like the solution that they came up with, but they fail to kind of talk about the business side of it. And I think that's important and evident in what you said as well.
Yeah, I mean, the solution can be as good as it can and really an astonishing solution, but the solution isn't interesting enough for an investor if you can't show cash flow. And essentially, if you can't show cash flow, essentially they will drop you out and they will not go forward with you. I mean, it's all about getting their return on their investment, and it's a hard world. It's not easy. It's really intimidating to go up on the stage and just start to pitch your own business, but it's a very good experience to learn how to do it. And sometimes you fail and sometimes you succeed. That's the thing about entrepreneurship, and 9 out of 10 will fail.
Sure. Going off of that, I wanted to end my presentation, I guess, giving like a little brief overview of what that pitching process might be like and what the investment process on the angel investors side looks like as well. And so before you're even able to kind of pitch, there's like a pre-screening process where you like email your submission, and that can consist of like a pitch deck or an executive summary. And this is pre-screened by a committee. And then if you pass that, you enter in like the normal screening phase where a company will come in and present, like Victor was saying, and generally you'll talk about your company and the solutions that it brings and like the business aspects of it. And then in this screening process, the people are polled as to whether they have enough interest in the business, and if the interest is there, then they enter in like an investor review stage where they can really get down and discuss term sheet agreements and negotiate kind of the amount of money they're willing to give. And that kind of leads way into due diligence, which is where investors will really spend time and dig deep into every aspect of the company, from the market, from its intellectual property to its competitors. And after that, the angels will manage their investments and provide ongoing support, with the final stage being exit. And that's where board members represent member interests and like try to seek the best exit possible. And so just to conclude, angel investing really allows companies to start up and thrive in the beginning. They have a huge positive impact on our local economy and on communities around the world. And without them, there wouldn't be as much success as you can see with eventual positive exits and IPOs or acquisitions. That's all I got for you today. Does anyone have any insight or extra comments that they'd like to share at this time?
I have a quick question for you.
Yeah.
In all the research that you did, which looks like you did quite a bit actually. So if you were to start up a company and you were looking for an angel investor, what would be your first step with that?
The first step that I would take would I think the biggest thing is just to try to talk to as many people as you can. People that you respect, people that you know are like veterans in that circle, and not be afraid to kind of shoot your shot. I have a friend who he went to Westminster and he started this app, and he literally wanted to try to find the best like angels or people or mentors that he could find. And so he literally started DMing people on Instagram, and he was able to talk to one of the people who ended up selling the Scan app to Snapchat. And so they've started they have like a really personal relationship. And though he's not invested in his company, I think that his story is important, and it shows that you should just try to talk to as many people as you can, because you never know what's gonna bite instead.
Awesome. Thank you.
So let's go ahead and turn the time to Alex, who, as our discussant, will not only bring out some points here and generate a conversation, but will also help moderate questions. Alex?
Yes, so thanks. Hi guys. So I'm going to talk more about the entrepreneur side. So first of all, I would like to know, so what do you think, why entrepreneurs, most of the time, they're first going to raise money through angel investors, and then later in the process, they're raising money with venture capital. So does any of you have thoughts about that? No? Well, so of what I understood, most of the time it's better to go see angel investors to kind of make your company bigger and make make your project more real, in a way that you're gonna raise some funds and that you're gonna develop your business, and then you're gonna see for venture capital, so your company will be bigger, and it's gonna be easier to have funds from these venture capitals, and also you will have a higher valuation, so they're not gonna take too much part of your company. That's one of the things I saw. And after that, it kind of going with what Victor said before, but even if you didn't have any experiences in that, what do you think can attract angel investors? So I don't know if any of you have thoughts about that. What can an entrepreneur do to interest an angel investor?
Well, what I think is that obviously, when you're looking for angel investors, you need to look for people who have knowledge from the field. So for instance, if you're looking for some technology, if you have a technology idea, then you want to look for angel investors who are involved with technology and have the experience, because they understand better that what you're trying to do, and then those kind of persons are the one who go for, and then obviously then you want to go for the local angel investors. You want to find them up and then get reach out to them, and then try to get the presentation time with them.
Yeah, so yeah, that's a good point. When you're an entrepreneur, you want to find not only people who's going to give you money, you want to find a good match, so an investor who can help you make your business bigger, and can also help you, sorry about that, can also help you to raise more money. So that's an important fact. You need to, as an entrepreneur, you need to do a lot of research about what kind of investor you should go see. And that a most common way to do that is to, as Reed kind of said, talk with friends and other people that already went through this kind of process, and they can help you by giving you advices on this investor is pretty good in this area or whatever. And when you find an investor, it's also good to kind of do some research about are they investing a lot, to be sure that they're gonna help you, and you want to know how they're gonna be during a bad time. Are they gonna just drop you, or are they gonna help you? So it's important to do some research about that. And
So,
also,
Alex,
yeah,
can I jump in for just a moment, please?
it's
So you have to think about this for a second. So angel investors are referred to as angels for a reason, because they typically are a response to prayer. Okay? The entrepreneur's prayer, which has everything to do with, oh, please save me and give me some money so that I can grow, right? So think about this from the perspective of the entrepreneur. You need to be looking for people that are going to be aligned with your interests. So the entrepreneur or the founder is going to be passionate about the product, but they recognize that the investor is going to be passionate about cash flow. And what sits in between the product and the cash flow is the founder, the entrepreneur, the individual. So the investor is going to have a reason to invest, which is going to be cash flow, but it's also going to be you. And it's going to be your commitment and passion to the product as well. So think about it from that standpoint. What attracts the investor? The cash flow, the person, and some affinity with the product or the range in which the product exists.
yes, and that's actually a big point that I saw about angel investor. They're saying that it's very important to find connection with them. So before going on a meeting or whatever. So exactly, if you, for example, if you want to raise money for a tech company, you want to find an investor in this area, and then you want to kind of know what are their interests to be able to talk about that during the meeting and try to find connection with them to make them more interested in your project. Because to give you a sense, I saw that some, like on the average, angel investors, they can have 200 meetings in a year with entrepreneurs, and they're going to help only 5 of these 200. So it looks like it's pretty hard to, even when you have a meeting, it's pretty hard to make them invest in your company.
I have a comment about the cash flow stuff. So I've been kind of seeing this phenomenon in like the more like big tech companies, big social media companies, where the first like 4 or 5 years of the company, really all they care about is engagement. And you can see this with like excuse me, with like Venmo right now. Venmo is just trying to get as many people to be dependent and like loyal to their app. And then they start like monetizing. So like if people who have had Facebook for a long time, Facebook didn't always used to be monetized, and YouTube didn't always used to be monetized, but it kind of grew as in an engagement stance at the start. So like when you're pitching to angel investors and you're trying to see like a new online service, something like Venmo, new social media, something like Facebook, right? How do you pitch something effectively, like without positive cash flow? Because that initial period, it's just really all about engagement.
So what I saw, it's kind of good to when you're pitching to talk about the supply and demand aspect. So you want to show the investors that your project is going to have a lot of demand, and that's how they can have a sense of the value of your company. Since as you said, it's early stage, and it's maybe hard to talk about cash flow. You don't have revenues, so they're more raising money about hope than about results. So you want to make them believe that you will have a lot of demands for your project, but you need to have strong arguments. You cannot just say like, yeah, a lot of people are going to buy our stuff in 2 years or whatever. You want to have a strong strong arguments about what you're going to do and how you're going to do and who's going to be your consumers and all that stuff.
Well, and Dylan, that's a really good point and question. So think about this. Absent the cash flow that frankly is rarely there in the early years, right? In fact, sometimes it's negative cash flow in the early years, more often than not. So absent positive cash flow in your history or that you show right now, what would you as an entrepreneur be willing to accept? Well, you're willing to accept other measurables that you then believe will be able to be converted to cash flow as the company continues to progress. So the Venmos and Facebooks and such in their earliest days, had they not shown users and transactions and profiles and such in a very robust growing trend line, they would have not continued to receive any investment capital. But they did, and so they received extraordinary investment capital. Mm-hmm. Well, Alex, is there one or two items you want to kind of finish up here with, or anything else that you might like to ask of Reed?
Well, I just not something.
Yes.
Is there anything else you'd like to finish up here with?
No, I think I'm good. Yeah, I think I'm okay.
Well, very good. So
can I finish off, Rick?
Go ahead, Jens.
Yeah, so I want to piggyback on your point about cash flow. So angel investors and seed investors, they don't think most of the time by single companies, so they think about portfolios. So they really understand the risk element that Reed was teaching us about. It's in a portfolio, it's about 10% of the businesses who make it to an exit, and maybe close to 5% grows big, right? So 1 to 2 businesses need to earn back in terms of exits the entire fund. So they need to broaden the risk and invest in many companies. And at that stage, you won't have any free cash flow, especially in internet-based companies that we talked about. So the investors are trying to recognize unit economics. So they're trying to see if, okay, I can add 1 more customer. Will I make money off of that transaction that I had in my lesson last time? And if that's true, the investor also wants the cash, the proceeds that the company raises, to be used towards operating expenditures. Because if the company deploys more operating expenditures in marketing, for example, they can add more customers. And if those customers create transactions that are profitable on a per customer level, the company will grow. So they're trying to recognize this early on and put money in if they see these trends in unit economics and not necessarily only cash flows.